Right now, if you ask 10 different Australians whether we're in a recession, you'll probably get 10 different answers. And honestly, none of them are wrong. Because depending on which number you look at, this economy is either holding up fine or it's already cracking. Stick with me, because by the end of this video, you'll know exactly which one it actually is. And more importantly, what to do about it either way. Let's start with a number that's supposed to make us feel better. Back in the December quarter, the economy grew a healthy 0.8%, or 2.6% for the year, the strongest result in almost 3 years. Champagne corks, right? Except that numbers already old news, because the moment 2026 kicked off, three things hit the country at once, and the economy has been wobbling ever since. And here's the part that should really grab your attention. Households were already starting to dip into their savings just to keep spending steady, even before this year's shocks properly landed. So let's get into it, because the gap between the economy is fine and the economy is straining has never been wider. And by the end of this video, you'll be able to spot which side of that gap you're actually standing on. Here's where it gets real. The Westpac Melbourne Institute Consumer Sentiment Index, basically a mood ring for the whole country's finances, has spent 2026 getting smashed. It crashed to a 2.5-year low back in April, clawed back a bit in May when the government temporarily halved the fuel excise, and then copped it again in June, landing at 80.6. To put that in perspective, that reading sits among the gloomiest in the survey's 50-year history. Right now, pessimists are outnumbering optimists by close to 20%. That's not a vibe. That's a nation collectively bracing for impact. And it's not just feelings. Aussies are pulling back on the buy now, worry later mentality that carried retail for years. Discretionary spending is softer. Big ticket purchases are being delayed, and household finance assessments have taken some of their sharpest hits on record. Back in April, fear of losing your job actually spiked to one of its highest readings in over 5 years, worse than almost anything we saw during the original cost of living crunch a couple of years back. When people start feeling poorer before their payslip actually shrinks, that's usually the first domino. But here's the twist. The thing actually driving all of this isn't one crisis. It's three, hitting at exactly the same time. And that combination is what's got economists genuinely nervous. Force one, interest rates. The RBA has already hiked the cash rate 3 separate times this year, taking it up to 4.35%. For anyone on a variable mortgage, that's not an abstract number. That's real dollars vanishing from the family budget every single month. And here's the kicker. Wages have only grown around 3.3% over the same period. So for a lot of households, pay packets simply aren't keeping pace with the combination of higher repayments and higher prices. Every time the bank moves, it drags a bit more spending power out of the economy, and it takes months to fully show up in the numbers. Force 2, the energy shock. Conflict in the Middle East sent oil prices surging earlier in the year, and because Australia imports the vast majority of its fuel, we felt it fast and hard. A ceasefire has eased the worst of it, and petrol at the servo has actually come down since the government halved the fuel excise on April 1st. Average unleaded dropped from around 206 cents a litre in April to about 182 cents by May. But don't be fooled into thinking the danger's past. That fuel shock is still working its way through the economy, showing up in everything from your grocery bill to the cost of materials on a building site. Housing costs alone are running at 6.5% annually, driven by rents, new build costs, and electricity prices jumping over 20% now that the old rebates have rolled off. Force 3, collapsing confidence. When businesses get nervous, they stop hiring, stop expanding, and start battening down the hatches. And we're already seeing it play out in the insolvency numbers. Construction and hospitality are still copping the brunt of it, industries that between them account for well over a third of all business collapses nationally. To make matters worse, the ATO has ramped back up its debt recovery activity after a couple of quieter years, which means businesses that were already stretched thin now have the tax office knocking too. Quick one before we keep going. Drop a comment below and let me know. Have you personally felt this pinch yet, or does your household still feel okay? I read every single one, and it genuinely shapes what I cover next. So where does that leave the jobs market? Unemployment climbed to 4.5% in April, the highest read since late 2021, before easing slightly to 4.4% in May. That's still historically low, but the direction is the worry. It's moving the wrong way, not the right one. Inflation, meanwhile, is genuinely a mixed bag. Headline CPI actually eased to 4.0% over the year to May, down from a peak of 4.6% in March, mostly thanks to fuel prices coming off the boil. But strip out the noisy stuff, and underlying inflation, the number the RBA actually watches closest, has been creeping up, not down. That's the classic sign of a central bank stuck between a rock and a hard place. They want to keep smashing inflation, but every extra rate rise pushes the economy closer to the edge. And then there's growth itself. The economy expanded just 0.3% in the March quarter, the softest result in almost 2 years, and a decent chunk of even that came from a boom in data centre investment, not everyday spending. Strip that one-off away, and the underlying picture is a lot weaker than the headline suggests. Even the household savings buffer is thinning out. The savings to income ratio slipped to 6.2%, down from 7.0% just 1 quarter earlier, which tells you households are dipping into their reserves rather than banking extra income. Some economists reckon the June quarter could come in even softer, possibly the first outright contraction since the pandemic. Now here's the number almost nobody talks about, and it might be the most honest one in the whole conversation. GDP per capita. The total economy can technically keep growing while your slice of it shrinks, because the population keeps growing faster than the pie does. That's why so many Australians feel like they're going backwards, even when the news says the economy's fine. Your grocery bill's up, your rent's up, electricity's up over 20% now that the rebates are gone, but your pay slip hasn't kept pace. That's not you being bad with money. That's the maths of a per capita squeeze, and it's been quietly running for a while now. And it's showing up in housing too. After years of relentless growth, national home values actually slipped in June, the steepest monthly fall in 3.5 years, as higher borrowing costs finally started biting into what people can afford to pay. The national median dwelling value still sits around $938,000, but that number hides a massive split. Sydney and Melbourne are leading the pullback with values actually falling, while Perth is still charging ahead with growth in the mid-20% range over the past year. It's not one property market anymore. It's 8 completely different ones, and depending on which postcode you're in, you're either watching your equity shrink or wondering what all the fuss is about. Technically, no. A recession needs 2 straight quarters of the economy actually shrinking, and we haven't seen that yet. What we're in is something economists call a per capita recession, or a growth recession. The top line number stays positive, but it doesn't feel that way for the average household, because it isn't. The Reserve Bank is walking a genuine tightrope here. Hike too hard, and you tip the country into a real contraction. Ease off too soon, and inflation gets embedded for years. There's no clean answer, and that's exactly why this year has been so bumpy. So here's the bottom line. Australia probably isn't heading for a textbook recession, but not technically a recession and feels fine are 2 very different things. And right now, most households are living in that gap. If you're on a variable mortgage, stress test your budget against at least one more rate move. If you've got savings sitting idle, now's the time to build a proper buffer, because cash is what gets you through a wobble like this. And if you're investing, remember, volatility isn't the same thing as losing money. Corrections are uncomfortable, but they're also where patient money quietly gets ahead. The data isn't telling you to panic. It's telling you to pay attention, get your own numbers in order, and make sure you're the one in control of your money, not the headlines. If this helped you make sense of what's actually going on, do us a favour and smash that subscribe button. It genuinely helps this channel keep going. Thanks so much for watching, and I'll catch you in the next one.